They always say, if you want to understand what's really going on, you have to follow the money. It's a classic line from the movies, but it's also the truest thing you can say about power, so let's do that. Let's follow a truly staggering amount of money. We're not talking about a few million here or a billion there. We are talking about $4.2 trillion. Yes, trillion with a T. That's the amount the US Federal Reserve conjured into existence to prop up the financial system during the last major economic crisis. It's a number so large it's almost meaningless, like counting the stars or trying to understand your phone's terms and conditions. This isn't just some abstract number for economists to debate. This is money that fundamentally reshaped our world. That $4.2 trillion was a financial lifeline, a massive intervention designed to prevent a total collapse. The Fed stepped in like a superhero, but instead of a cape, it wore a suit and carried a briefcase full of newly created digital dollars. The goal was to keep the gears of the economy from grinding to a halt. They wanted to make sure banks could still lend, companies could still operate, and the whole system wouldn't just freeze up like a laptop with too many tabs open. The question is, who did that superhero really save? Think about what $4.2 trillion could do. You could end world hunger for decades. You could rebuild America's entire infrastructure, from bridges to broadband. You could give every single person in the United States a check for over $12,000. So when the Federal Reserve decides to deploy that kind of financial firepower, we have to ask the important questions. Where did it all go? Who decided who got a piece of the pie? Did it work for everyone, or just a select few at the top? The story of this massive bailout isn't just a history lesson, it's a blueprint for the future. As we stand here today on January 15, 2026, the aftershocks of that decision are still being felt. It affects the price of your groceries, your ability to get a loan, and the health of the job market. Understanding this $4.2 trillion lifeline isn't just for Wall Street traders or people who wear monocles. It's for all of us. Because when the next crisis hits, and it will, the same playbook might be used again. We need to follow the money, not just to see where it went, but to decide where it should go next time. So, how does a government agency just create trillions of dollars? The Fed can't just print stacks of cash in its basement. It's more sophisticated than that. The main tool they used is called quantitative easing, or QE. It sounds complicated, but the idea is simple. The Fed buys things, mostly government bonds, other financial assets, from big banks. When it buys these assets, it pays by crediting banks with new, digitally created money. Suddenly, banks are flush with cash. The hope is that they will take this new money and lend it out to businesses, lend it out to individuals, stimulating the economy. It's like the Fed is the ultimate rich uncle, buying your old comic books for way more than they're worth. But QE wasn't the only tool in the shed. The Fed also set up a whole alphabet soup of emergency lending programs. There were facilities to backstop money market funds to buy corporate debt, and even to support loans for medium-sized businesses. Each program was designed to plug a specific leak in the financial plumbing. When investors started panicking and selling everything, the Fed stepped in and said, "Don't worry, we'll be the buyer." This calmed the markets down, because everyone knew there was a guaranteed customer with infinitely deep pockets. It was a clear signal that the Fed would do whatever it took to keep the system from imploding. Think of the economy as a car that suddenly ran out of gas on the highway. The Fed didn't just bring a small can of gasoline. It showed up with an entire fleet of tanker trucks and started spraying fuel everywhere, hoping some of it would get into the tank. They lowered interest rates to basically zero, making it incredibly cheap to borrow money. This was meant to encourage spending and investment. By making money cheap and plentiful, the Fed was trying to get the economic engine to restart. The immediate goal was to restore confidence, to stop the panic, and to make sure the financial markets could function smoothly again. It's important to understand that these actions were different from the government sending out stimulus checks. That's fiscal policy, which is when Congress and the president decide to spend money directly. The Fed's actions are monetary policy. They don't give money directly to people. Instead, they give it to the financial system with the expectation that it will trickle down to the rest of the economy. This is a crucial distinction. The Fed's lifeline was aimed squarely at the heart of the financial world, not at the average person's wallet. The benefits, therefore, were always going to be indirect for Main Street. When trillions of dollars flood into the financial system, someone is going to get very, very rich. The most direct beneficiaries of the Fed's actions were, without a doubt, Wall Street banks and large investors. The Fed's programs were a safety net made of pure gold. By buying up massive quantities of bonds, the Fed drove up their prices. Anyone holding those bonds, pension funds, hedge funds, wealthy individuals, saw the value of their investments soar. It was like owning a house and having a mysterious buyer offer to pay double what you paid for it, no questions asked. The stock market responded in kind, rocketing to new highs. The big banks also won big. The Fed's emergency lending facilities and cheap money made their operations incredibly profitable. They could borrow money for almost nothing from the Fed, then lend it out at higher rates, or use it to trade in the newly juiced-up markets. The risk of major losses was taken off the table. The Fed basically became the ultimate insurance company for the financial sector, and the best part for the banks was that they didn't even have to pay a premium for the policy. So, if Wall Street got a feast, what did Main Street get? Well, the argument is that they got the leftovers. The theory of the Fed's actions is that a healthy financial system would eventually benefit everyone. A stable Wall Street means banks can keep lending to small businesses. A rising stock market makes people feel wealthier. People are more likely to spend. Spending creates jobs. To some extent, this did happen. The intervention prevented a much deeper recession. That deeper slump would have meant catastrophic job losses. In that sense, Main Street was spared from a worst-case scenario. The bleeding was stopped. However, the benefits were far from direct or evenly distributed. While the Fed was pumping trillions into financial markets, many small businesses were struggling to get a simple loan. The local pizzeria, the hardware store, they didn't have access to the Fed's corporate bond buying program. They had to go to their local bank, cap in hand. Banks, despite being flush with cash, were often hesitant to lend to small, risky ventures. The money seemed to get stuck at the top, circulating within the financial system instead of flowing out to the wider economy. For the average worker, the impact was a mixed bag. The jobs picture did eventually recover, but the recovery was slow and uneven. Many of the jobs that were created were in low-wage sectors. One of the biggest problems with the Fed's massive intervention was the lack of real-time transparency. When the government spends money through fiscal policy, congressional debates, public votes, budget reports, it happens largely out in the open. The Fed, on the other hand, is designed to be independent of politics. Decisions that affect every single American were made by a small group of unelected officials behind closed doors. The details of who benefited were murky and slow to be released. For a long time, the public didn't know which corporations sold debt to the Fed or which institutions accessed emergency windows. This secrecy fueled suspicion and a sense that the game was rigged. This opacity also created what is known as moral hazard. Protect people from consequences, and they take bigger risks. Wall Street learned the Fed will be there to save them. A dangerous incentive structure. Profits are privatized, losses are socialized. Pumping $4.2 trillion into the economy has consequences. It can lead to inflation, too much money chasing too few goods. It can create asset bubbles, disconnecting prices from real value. When bubbles pop, another crisis can follow. The Fed walked a tightrope, and the lack of transparency makes it harder to judge whether they succeeded. So, if we agree this system has problems, how do we fix it? We don't need to tear everything down, but we can make common sense reforms for a fairer outcome next time. First, demand clearer and faster reporting. When the Fed launches emergency programs, who gets money, and on what terms should be public and easy to understand in near real time. A public dashboard tracking every loan and asset purchase. Second, clearer legal limits on emergency powers. Flexibility, yes, but not a blank check. Congress should set specific guardrails. For example, restrict support to firms not doing massive buybacks, require supported companies to maintain payrolls. Third, stronger independent oversight. A body, GAO, or a new entity, with real-time audit powers and subpoena authority, reporting to Congress and the public. This isn't about politicizing rates, it's about accountability when public money is at risk. Clearer reports, legal limits, stronger oversight, basic good governance to bring sunlight to high finance, rebalance the scales. At the end of the day, the story of the $4.2 trillion lifeline comes down to a simple truth. It's our money. Even if it was digitally created, the value is backed by the full faith and credit of the United States and the future productivity of its people. Every dollar the Fed creates affects the dollars in your pocket and the stability of the economy you live in. Risks, inflation, asset bubbles, moral hazard. Those risks are not borne by the Fed governors, they are borne by all of us. The debate isn't about whether the Fed should have acted. In a meltdown, doing nothing wasn't an option. The real debate is about how they acted and who benefited most. Evidence suggests the rescue favored the wealthy and well-connected, widening the gap between Wall Street and Main Street. A recovery for the stock portfolio, not necessarily for the family budget. Move the conversation to the town square. Demand oversight. Support transparency. Next time the Fed moves, don't just change the channel. Pay attention. Ask the hard questions. Follow the money. Demand a system that is stable and fair. Demand a recovery that lifts all boats, not just the yachts. The 4.2 trillion question has been asked and for the most part, answered. Now it's up to us to write a different answer for the next time. If we don't, the same people will be first in line for the next lifeline, while everyone else is left to tread water. Because in the end, it's our economy, our money, our future.